Hi guys, Max here, and this is of course your daily market update for yesterday, the 2nd of August. Now, as you can see from this heat map behind me, it really wasn't a great day for the markets. Most stocks on average fell actually. There were a few that rose, but that was mostly based on individual circumstances like companies like Uber posting good results for once. Now, the reason for this fall is basically just that the rally is running out of steam because the rally that we saw over the last month was based on the idea that maybe we're at the end of the Federal Reserve's tightening sequence, which I personally think is ridiculous and a very naive thing to think. But that was what the market was pricing in. And now they're sort of starting to realize that actually they were probably wrong. The Federal Reserve came out, or a bunch of officials from the Fed came out, and they said that no, tightening is nowhere near over. On the whole then, the S&P 500 fell by 0.7% and the Nasdaq fell just a little bit by 0.2%, with the Dow Jones falling by 1.2%. Over in the rest of the world, it was a similar situation for the most part, with most countries' stock markets falling. The one that did well was China's, and that's basically because there wasn't war. Of course, Nancy Pelosi flew over to Taiwan, and China was threatening the US with shooting down her plane and US military planes and all sorts of things like that. And that was a little bit worrying for markets, but as we all expected, nothing came of that. The FTSE 100 then fell by 0.1% and the Stoxx 600 fell by 0.3%. So on the whole, the MSCI World Index fell just slightly by 0.1%. The dollar strengthened, as we have been seeing so often these days when risk on equities actually fall. And so the euro fell by about 1% back down to $1.02. The British pound fell by about 0.7% down to $1.22. And then the yen fell by more than 1% down to 133 yen per dollar. In the bond markets and risk on assets, we actually had a really volatile day with US 10-year treasuries with the US 10-year Treasury yield rising by 17 basis points up to 2.75% in one day. That is really massively volatile. And again, this is just based on the idea that over the last couple of weeks, the markets have been pricing in the idea that the Fed isn't going to hike interest rates anymore. And of course they are going to, and the market and investors are now realizing that and panicking, so they're repricing these assets. We saw slight moves in similar directions for other bonds, but not by quite a dramatic amount as that. The German 10-year yield rose by 4 basis points and the British was up by 6. Finally then, for commodities, well, oil prices fell very slightly, but they're at the exact sort of levels they were at yesterday, to be honest. WTI crude is sitting at $94 a barrel and Brent crude is sitting at $100. Gold prices then fell very slightly too, but they're still sitting at around about $1,780 an ounce. Finally then, what happened in the crypto market? Well, crypto actually performed relatively okay and rose for the day. Bitcoin sitting above $23,000, Ethereum sitting above $16,000, and most altcoins were up as well. So this was an example of crypto actually not moving in a risk-on correlated way, and it isn't actually abundantly clear why this happened. We did get some news out of the crypto sphere, but it really wasn't anything major. Michael Saylor has stepped down from MicroStrategy. He was the CEO, and MicroStrategy is of course a hedge fund that just buys Bitcoin and does pretty much nothing else. Anyway, they posted a $1 billion loss, which is massive for them because the price of Bitcoin has crashed over recent months. He's also the exact same person who got caught up in the dot-com bubble. He ran a hedge fund back then, and he had, I think, the worst performance of any hedge fund manager in America, losing something like 99% of the entire value of his fund over the course of a couple of years. This time it seems that it really is no different. I don't really why people didn't see this happening this time around. Someone who gets caught up in the hype like that is of course just going to get caught up in the next bubble too. Now, as I mentioned briefly earlier, the narrative that's encapsulating the markets right now is surrounding the Federal Reserve and the idea that actually the pivot is less likely today than it was a week ago. And so investors are repricing assets. Now, why are investors actually paying attention to this and changing their minds? Well, a couple of different officials came out and said a few different things. One in particular was Mary Daly, who said that the Fed is nowhere near done with rate hikes, which is a little bit of a damper on the rally that we've seen recently. What is clear, in my opinion, is that tightening is still going to continue, and this is the opposite of what this rally over the last month was based on, and so this is bad for stocks. It does seem that the steam has almost entirely disappeared, but it was just entirely irrational anyway in the first place. The rally over the last month never made sense to people who actually looked at the data. It only really made sense to people who tend to get caught up and encapsulated in trends and in just following what's happening yesterday as opposed to what's going to happen in the future. Now, we have some news out of the UK. Of course, it's Wednesday today, but tomorrow the Bank of England, our central bank, is going to give us their decision on their most recent decision for a rate hike. And we're expecting a 50 basis point rate hike, which will be the highest one we've had, as you can see, in 27 years. We're also expecting to see a brand new plan for quantitative tightening to be announced. Now, the UK has seen about $1.1 trillion worth of stimulus over the last decade or so, and that's about 35, maybe even 40% of British GDP. So that's a massive amount. Personally, I'm skeptical as to whether or not the Bank of England will actually start selling off their balance sheet. The Federal Reserve has been trying to do that for almost 2 months now, and there's just no demand for the assets that they hold. So they are just not selling off their balance sheet as they claimed they would. So we should take any plan that is put out by the Bank of England and any other central bank with a little bit of salt. It's also worth noting that actually just the economy over here really isn't great right now, and most of the data that we have regarding the economy is a lagging indicator like unemployment. Unemployment doesn't fall before the recession, it falls as the recession starts, and so we get that data afterwards, but we are now starting to get that data showing that, yeah, the recession is definitely here. Insolvencies, so just businesses going out of business in the UK, is at its highest level right now since 2009, since the global financial crisis. This is partly due to the fact that this COVID era government support for small businesses has ended, but in reality, this is just the sign of a recession. It's what happens when people are poorer, and that's exactly what's happening right now. People are poorer because of insane inflation and the cost of living crisis. And yeah, this is just the data to prove that we're in a recession. Of course, we'd be amiss if we didn't mention at all Nancy Pelosi visiting Taiwan today. Now, in the run-up to this visit, China were threatening a whole load of things. They said that they will shoot down her plane. They said that they would shoot down any other US fighter jets, that her going to Taiwan was an act of war and an invasion itself. But of course, once she got on the plane and flew there and landed, nothing happened at all. China did put out a whole load of military drills, and they're planning more as well for the next few days. They sent a bunch of amphibious tanks onto beaches, across the Taiwan Strait to try and scare people and get media attention. But there really wasn't any response from China, which is exactly what we expected. It's also worth noting that it isn't actually very uncommon at all for US officials to visit Taiwan. It's happened loads of times in the past. It's just that Speaker of the House is a little bit more senior than the positions that usually go over there. So that seemed to be why China was trying to put a stop to this trip. One thing that is very funny, and I thought I'd just mention to you all as a bit of a humorous point for this video, is this idea of China's final warning, which I had heard before, and I was aware that it was this idea that it's basically a warning with no consequences. And here's the Wikipedia page behind me explaining exactly what it is. It's a Russian proverb that originated in the Soviet Union to refer to a warning that carries no real consequences. What is funny though, and what I didn't know, is that this term actually emerged during the 1950s, back when China and Taiwan were still in a hot civil war, and the US was sending a bunch of fighter jets down the Taiwanese Strait to show that they supported Taiwan. And every single time this happened, the Chinese government, the Chinese Communist Party, would issue a final warning saying that this is the last one, next time we will shoot you down. And over the course of about a decade, they issued 900 final warnings to the US. So that's where this idea of China's final warning comes from, a warning that has no consequences at all. Now, in my opinion, this whole charade has basically been China pandering to its own population and riling up support against the US and for the Communist Party, distancing itself and trying to get people to forget about the massive problems going on in China right now, because they really are monumental. Now, that's most of the news for the day. Now we just have corporate earnings reports, and I'm afraid there is a whole load of stuff to talk about. So we're just going to cover each company very briefly and in a little bit less detail than usual, because otherwise we'll be here for ages. So firstly, we have Robinhood, who put out their earnings, which wasn't a brilliant report, but it wasn't awful. After hours, their share price is down by about 4%, but then it mostly recovered, and as I speak, it's down by about 1%. Now, they made less revenue than investors were expected, but they also made a smaller loss than investors were expecting, so nothing really special there. They did, though, see a decline in monthly active users and a decline in the amount of assets that they're custodying on behalf of their customers. Now, this is expected with a bear market. People get less interested in financial markets, but it still isn't good news. They were also just fined $30 million by New York for not abiding by anti-money laundering regulations regarding cryptocurrency. And they've announced that they're going to be cutting 23% of their staff because they're not confident about their ability to, make money in the future. So it wasn't an awful report, but it was still bad. Then in contrast to that, we had Uber's report came out, which was their first ever in history cash flow positive quarter, which everyone's really excited about and investors in particular are really excited about. So their share price rose by 22% overnight on this news, which is really good for them. They actually beat their free cash flow expectations as well. They were expecting $110 million and they got 380, which is a really solid result. For a long time, no one really knew at all if Uber's business model could actually be profitable. And this is encouraging and it suggests that actually it can be profitable. The company did still lose $2.6 billion over the last quarter, but that's because they made a whole load of awful tech company investments, as most tech companies did over the last few years. The question it's facing now is, can it sustain these levels of profitability into the future? And investors seem to think so. Next, we have PayPal, and their earnings were strong as well. And so their share price rose by 11% in after hours trading. Now, their earnings was a beat, their revenue was a beat, and they actually saw 9% revenue growth year over year too, which was good there. They also put out some good forecasts for the future. They want to cut costs for the entire company of $900 million this year and $1.3 billion next year, which is nice. And then they announced a $15 billion stock buyback program, which is of course great for investors too. So for PayPal, it was happy days all around. Next, we have Starbucks, who saw a rise in their share price by about 1% in after hours earnings, which was a little bit less good than others, but actually the data wasn't awful itself. They've had a really bad quarter and a bad year actually for China. Their sales in China are down 44% year over year, which is their second biggest market. That's pretty bad. And they're actually refusing to give forecasts for their business as a whole in the future because they're not certain about the business environment and how they're going to perform. So that isn't very good. But then the data from last quarter was good. The earnings and the revenue that they posted was actually a beat of expectations. So it's quite difficult to price this report because it has bad news and good news and it isn't really clear which one is better. So after hours, the share price has been incredibly volatile. And as I speak, it's pretty much exactly where it was before close, but it has been up and down since then. Finally, then, the last company to post an earnings report was AMD, and they had good data for the last quarter, but bad forecasts for the future. And so the share price is down by 7% after hours, which is really quite an aggressive fall and not at all what investors were hoping to see. Now, they beat their earnings and revenue figures for the last quarter, but only just by less than 1% on each account, so nothing stellar there. And then for the next quarter, their forecast was really quite weak. They think it's going to be difficult for them to market and sell PC computer products as the recession kicks in, so investors are a little bit unhappy about that. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.